Good, right around midnight for me, everybody. I'm doing, by popular demand of just myself, I'm doing AMC today. So I have no idea what their financial situation is going to look like. Probably a ton of debt if I had to guess. Have not looked at it yet, but we're going to get into it because I want to. If you want any stocks reviewed, comment down below what you want. Make sure to subscribe as well. Like the video, maybe. Don't have to, I don't care. But let's get into AMC. So as I'm just getting my setup recorded or set up here at the moment, I've noticed AMC is actually one of the top trending stocks at the moment for some reason. I have no idea why, but hopefully we'll find out. Could possibly be earnings, considering their next report date is in February, but I have no idea. But anyway, let's get into it. So you can see their business segments here. Of course, they have information and not all of it is filled out, but business segments, man, I really got to restart this. So getting into AMC, unfortunately, they don't have any specific industry stuff here, just their business segments. But you can see how their performance has been over the past few years, obviously getting explosion by the whole hype train. And now they are essentially back down to where they started, actually much, much lower than before they started, which is kind of rough, but that's just what happens when you pump a company that doesn't really have a lot of value. So let's just get into it. Their cost capital is at 11.6. Target price is right around $4. So they're most likely going to drop even further than they already are. Long-term growth rate is non-existent. However, considering it's movie theaters, I'm going to give them a big fat 0 for that. I am a movie theater lover myself, but let's be realistic here. Not a very good long-term growth rate. Further sales, we could see sort of a steady decline over the past few quarters. Let's go into the years here and really see the bigger picture. Actually, a peak in 2023 followed by a decline. Now, you can also see here they took a massive, enormous hit in 2020 with COVID, obviously. Before that, they were basically steady earnings growth up until that point, and they almost got back up to like the recovery zone in 2023, and it looks like they're going to start dropping back down now. So it could just be another slow burn. But considering their earnings are almost recovered to where they used to be, I'm going to give them the 0.5 at least there. Operating income is going negative again. Not a fan. 0. Net income, again, is just diabolical. I don't know if it was ever positive. Okay, so it was positive many years ago, but has not been in a while. So that is not great for the company overall. Not fantastic. Hopefully they can bring that back in the next few years, but I mostly doubt it. EPS is improving. Now, is that because there's more shares? Yes, that is entirely because there's more shares. This EPS essentially means nothing. And even though it's improving, I'm giving it a 0 because, as you can see from their shares, they have been enormously diluting themselves. That is another reason their stock price is so low, because their dilutions are crazy. So let's go to the balance sheet, see what's up with their assets. I'm sure we'll see some sell-offs. Can't imagine they're holding. And yeah, over the past 2 years, they've sold off almost $2 billion in assets. Mostly expected, although clearly their operating income and profitability haven't really turned around too much from that. So could be an issue. with cash, which I accidentally just filled in for assets, cash looks okay for their short term, but really, really bad for their long term. So you can see they have been focusing on repaying long term debt, which is good. I'm going to do a 0.5 for cash only because it just doesn't seem like that much compared to how much short term debt they have at $500 million. They can obviously cover it very easily, but with how much long term they have, it just seems like a lot. So for short term debt, I'm going to do another half there only because they have a lot of it. And you know what? Actually, I'm changing my mind. I've done it in the past, but they have enough cash to cover their short term, and their short term is decreasing, which is what changed my mind. It's been going down for the past 2 years, which is good. Overall debt has been decreasing for the past 4 years, basically, and I'm sure it's decreasing further this year. Retained earnings is most likely super duper negative, obviously, which is whatever there. Let's go into the cash flows. Hopefully we see some goodness here. And obviously we will not with the operating, not expecting much there. For the investing cash flow, it's basically just normal. And then obviously massive, enormous stock dilutions. In financing, not great there. And overall free cash flow just looks bad. So moving right along here, fairly quick one actually today, only because everything is pretty bad. A lot of debt repayment though. You could also see a lot of issuance recently, but it looks like they've been outpacing it for the most part, at least over the past few years, especially with how much interest expense they have. They have an enormous amount of interest expense, but zero debt issuance in 2023, which I like. So I will be giving the credit there. Obviously, no stock repurchases. They've been issuing like crazy, but what are you going to do when you're in a situation like theirs? So let's head into the ratios, see what we're seeing. So SGA to sales has been very drastically decreasing, way below the 5-year average, which is good. They've clearly been cutting costs. However, considering it's SGA, it could affect their bottom line there just because they aren't doing as much like selling and advertising expenses. So that could definitely have an effect. Their 5-year margin average is 91, and their last full year was an 8. So I am going to do the half credit here only because clearly they've been improving a little bit. 2020 was just a horrible year for them. They got annihilated. Assets and equity returns, you can see, have been slightly improving, but honestly, equity doesn't even show up because it's negative, and assets have been being sold off, so I'm not giving the credit there. Long-term debt total equity, you can see, again, it should, in theory, be improving here because they're reducing their debt, but they have no equity at all. Their equity is negative, so not great there either. It's going to be very high for a while, very, very low for a while because they have zero equity. So overall for AMC, we have a 26%. Honestly, I expected this. They just got absolutely annihilated from COVID. Really, there's nothing that the company could have done to prevent that. But all in all, they were declining anyway, just because movie theaters have kind of been less positive, or less popular, I should say, recently. So nothing too unexpected there. Let's get into the earnings report and see what is happening here. I really need to start bringing them up before I start recording, but it's all good here as it showed up. So overall, we can see missed on admissions, beat on food and beverage, which is something at least, actually very significantly by about almost 30, little over 30 million, which is good. Other theater revenue missed slightly. EBIT was a beat, which is really good for them. Attendance, I don't know if that's up or not, but attendance. Ticket price whatever, and revenue per patron you can see from food and beverages right here. So I wish they had like the before and after numbers there. I don't think they do. But other than that, it looks like we can go into here and see a little bit more information. This is just the overall revenue estimates. You can see here they beat overall on revenue. They beat on their EPS, which is good. And their cash was at $500 million, which for this company is actually pretty solid, only because um, oh, that's a screener. Only because, as we can see here, if we go back to their market cap, it has fallen a lot. So they have a quarter of their own market cap just in cash, which honestly is probably good for them. Hope they could weather the storm as much as they need to, but that is about it for AMC. So let's go here and look at their stock chart, and I can just show overall what's going on. So you could see they had a bit of a pop a few months ago where they really just it came after earnings, but the earnings weren't great, and you could see they obviously had a bit of a hype from it, and they are still above where that point is, but I really just can't see the stock coming back from where it is, or ever going back to where it was. I mean, usually whenever a stock chart flatlines, like how you see here, where their past stock movement just completely overshadows where the current price is, it's probably not going to be great. Did they do a reverse split here, or is this 1-for-10? So they did 1-for-10, one share for 10. So I believe they did a reverse split, and that is how their stock price is currently positive, because I think that's what happened. I don't think they did a regular split. I feel like it would be the other way around, 10-for-1, which makes more sense. Yeah, reverse split. So anyway, stock price does not look great. Most likely going to have a rough couple of years, especially considering that negative net margin and all that. So that is it for AMC. Hope you enjoyed. Hope you learned something. I will see you in the next video. Make sure to subscribe.